Hello. Good evening, everyone. Welcome and thank you for joining tonight to our 4Q 24 market outlook, which our theme will be the flows versus fundamental. I'm your moderator tonight, Adrian Ng. For those that have been joining, thank you for your support. For those that have just joined, please continue your support. And tonight, we have a very interesting lineup. Why do I say so? I would like to take tonight's opportunity to introduce our new head of research, Peter Kong, to you. And due to the excitement from Hong Kong, we are also doing something a bit more special tonight for you guys, especially for you guys only, which we have invited Mr. Danny Chu from the Hong uh, Hong Kong side, where Hang Seng Indexes Company. My English is not that great, by the way. So well, and last but not least, we have Isabelle. And for those you know who she is, you know who she is. And if you do not know her, she is one of the very few rare female warrant issuers in town that have won multiple awards. And a sidekick, Boss Moo. Yeah. So all right. A brief introduction of Peter would be he's our new head of research, and previously um, he has an award-winning analyst for financial and industrial sector with CLSA Securities, Malaysia. And tonight he will actually present us the outlook from Malaysia and how the geopolitics around is happening. And after his session, we'll follow suit with Mr. Danny Chu, which is the head of index research strategy at Hang Seng Indexes Company. And before he joined this current company, he is actually a Greater China telco analyst, which is highly rated in all Asia research team as an institutional award and been ranked number one consecutively for many years. And yeah, and we will top it up with a session where Isabelle would always remind us to maximize our value of our investment by adding a kicker to it, and she'll guide us on the know-how. So without further ado, just a bit of a housekeeping. For those that have questions, you can actually put in the chat box, and we shall actually highlight it. And for those that have not been a Kananga client, that is a link on the chat box here, which is pinned. You can check out all these links. And yep, do read the disclaimer too. Okay, so without further ado, I shall start the session. Yeah. Hi, Peter. It's good. Floor is yours.
All right, thank you, Adrian. Hi, good evening, everyone. Thank you for dialing in, and I have the privilege to be your first speaker today. So, as Adrian has mentioned, I was previously from another research house, and during my time there, I was the deputy head of research for 6 years, in which I was instrumental in broking Malaysia to a lot of the regional fund houses, including in UK, US, Hong Kong, Singapore. So as much as I can, today I'll try to add value and try not to embarrass myself in front of Danny in terms of flows in the region. And obviously, there are a lot of talking points locally, including what we think is currently cheap and worth looking at the moment. And but I think in the first place, perhaps the right way for me to start off this evening is to give you a view on the overall picture. So if you just allow me to share my slides. Yeah. So I think without further ado, I would like to start off my presentation with some of the global slides before going into some of the flows, and then looking at just very quickly the sectors and the stocks that we like. And I'll be happy to take some questions if you still have at the end of it. I think from the top of the tone, I'd like to set is that at the top of the meeting, I'd like to set the tone that Kananga is still effectively bullish. I think I have been here for about 2 months. And when I first joined as head of research here, the biggest talk of the town back then was the Fed pivot, when it would happen and what would ensue if it does happen. It was one of the most, I would say, expected Fed rate cuts. But the question is, how do we then interpret it? I think history is on the side of the KLCI. Down here and the bottom graph, we have plotted out the returns over a 3 to 12 months horizon from the time the US pivots, or in simpler terms, has a rate cut. And you can see out of the 10 instances that we have recounted in recent memory, only three such instances did we not see a return on the positive side at the 12-month anchor. So when we look at a 12-month on average, and this is the median return, we will normally have about 8% median returns. The only two times that we didn't see positive returns, to no one's surprise, was a global financial crisis and also COVID-19. So in that sense, it gives us a very important anchor to know that within a 12 months period, usually things are not as bad as feared. But of course, is it all hunky dory? I think coming from the investment community, especially on the institutional fund manager side, there are always typically looking out for signs, be it from the equities market or even the bond market. So I think one of the leading indicators, or one of the signs that the fund managers like to look out for, is whether the bond market would warn of any future economic difficulty. And this is in the US. For those of you who followed the US and also the rate cards, what we would know that the the short-term rates in US has stayed far too high for too long. So the big question right here is, if the rate cut happens now, is it already too late? Should Powell have cut a bit earlier? So there are so many questions, and the bond market in the past has been a relatively good predictor of future economic difficulties. Although this time we beg to differ, we think that history will unlikely to repeat itself. This dotted line that you see on the horizon that I have highlighted, that is when the line graph passes that dotted horizon. That's usually when the rate cuts happen, and you see what the investment community like to call disinversion of the yield curve, meaning to say that short-term rates now are smaller or lower than long-term rates. In quite simple language, that is just a normalization of interest rates. And when the not interest rate normalizes, I think what fund managers have in the past been able to observe is within 3 to 6 months, there usually can be a confirmation sign of whether US will go into recession. We think that in Kenanga, we believe that it will be a soft landing scenario. We think that there's no evidence at this point in time that there is a hard landing case. Furthermore, we think that currently, if you look at this chart and on the bottom right, we have been in a abnormal interest rate environment for a good part of 20 over months. So I think the market is more accustomed to the current environment and won't have a major reversal in terms of sentiment. Now, having said that, the whole idea of showing you the previous chart is to say that while we believe in a 12 months period or so, we generally get a positive return. It also means that more institutional fund managers, for example, in the near term, 3 to 6 months, would likely not fully deploy their cash, will likely not be highly invested because they are watching out whether or not history will repeat itself. So we believe that there is still more positivity down the road when they can clearly see that a recession is not on the horizon. Now, of course, today's big topics are China stimulus for those who follow news flows. Today, I entitled my topic "Flow flows versus fundamentals, because just want to highlight what is more hot money in investor language that we need to be a little bit more aware of today. But nonetheless, let's continue to stay at the U.S. politics scenario. I'm not a big expert in U.S. politics, but I think at this point in time, the best way to position ourselves is to use what the market is trying to tell us. Currently, the market is trying to tell us on the left chart that is a 5 years 2 years polling, sorry, polling result. And this poll that I have picked out is actually from a poll average, meaning to say that it is actually already an average. And we do that because we want to remove all the biasness of the various media channels. And under this result, we have seen that over the past few months, it looks like the blue line is on top of the red line, indicating that Harris has a little bit of a lead. But this lead currently is still in the area of what we call margin of error, because it's still within 2 percentage points. And in the past, in the elections in the US, 2 percentage points is within the error where it is too small to take seriously. Moreover, if we were to look at some of the swing states on the right, your Pennsylvanias, your North Carolinas, and the like, we do see that actually whilst there is a lot of red lines indicating that Trump is having the lead here is no more than 1.4% based on the same poll averages. So from looking at big picture and from the swing states, we aren't able to conclusively tell what is the outcome. Then how do we then the bigger question is, why do I bring this out, and how does this help in our investment decisions? I think the bigger picture here is what the investment community is probably thinking. I think I believe what is happening right now is because precisely the outcome of the elections is too difficult to call. There is no way for any market participant to fully price in any clearly what scenario will pan out. For example, when we compare some of the Trump policies versus some of the Harris policies, we know that the Trump policies, for example, call for more tax cuts to continue, and that's generally seen to be market friendly. Although this will benefit the US market in the near term, there could be ramifications for outside of US, for example, calling for very broad-based sort of tariffs, and those are less business friendly. We also know that Trump is no friend of ESG and electric vehicles, for example. But what we know when comparing Trump to Harris is that Trump, because of his policies, will probably cost the US taxpayers more money, in that they will have to have even higher budget deficits. So this means the proverbial can is kicked down the road even further, and they would have to print more money for that, for example. So I think in that type of scenario, I think the general view is not just something that Peter Kong is saying, but look at what Bloomberg has also quoted. So Bloomberg has also quoted a poll to ask the people, if Kamala Harris were to win or were to win, how would you invest your money? So in this case, we see that that only 23% say that they will put their money to work in stocks, whereby there are 50% who say that for Trump. So this gives investors like you and I a way to think about the market, that if Trump was likely to be the champion or the victor, and we will discuss this very soon because November 5th is coming, we will then know how to deploy our hard-earned money, into work in stocks. Of course, the near-term impact for Malaysia is not always very clear on a Trump victory for on two fronts. We think especially given the tit for tat or the friction and tension with China, this could also cause some pressure on currency, given how closely the ringgit is seen to be or perceived to be linked to the Chinese yuan. And also the Trump, he is not the best friend of ESG, and he has made it very clear that he will increase the domestic production of oil. This in this case, I think those who watch closely the oil markets will already know that even under Biden, production of oil is very high, but I think sentiment will be the key determinant factor over here that will probably pressure oil in the near term. Okay, just one more slide on US. Um, the reality is US elections behavior very easy to tell in that it's always 4 years and typically it's always in November. This gives us a little bit of a ability to look for patterns. And one of the clear patterns is in this indicator called VIX, which the investment community on the institutional side like to look at because it tells how volatile a market will be on a forward-looking basis. And on a forward-looking basis, this is about 30 days. So in the anything more than closer to 30, sorry, likely indicates a lot of uncertainty and fear in the market, and anything below 20 is seen to be quite benign. So we can see 7 out of 8 times, and over here I use a 35-year chart, after elections in November in US, typically uncertainty will also come off. So in terms of timing, this chart is something that I created for you so that you can take away in terms of how to position and the timing to do so. I will probably spend the next 5 minutes to talk about some of the flows before I go into the fundamentals. China is a giant compared to entire of ASEAN. When we look at the China funds, we can some of the agencies and companies provide some tracker ability, meaning to say they will compile and they will tabulate how much funds are being flown back into China. And those who follow closely will know this is because after the share market in China has been in the doldrums for a couple of years, what we have seen is in the week of 23rd September, the Chinese central bank unveiled the largest stimulus since pandemic. And the whole idea here is to get China back to its 5% growth path. Once that was announced, we saw massive outflows in the region, and Malaysia was also not spared. Quoting one statistics alone, in the first week up to 9th of October, there was 40 billion US dollars flowing back to China. But we also felt the heat over here in Malaysia. But actually, if you look at the bigger scheme of things, a lot of flows came from India. So India, I think, saw about 8 billion, 4 billion of flows within that same period. And Japan also saw one of its largest weekly flows on record. So I think the reality is that whilst we are worried about our Malaysian stocks to some extent, the other markets are the one that are seeing the more massive outflows. ASEAN as a whole is quite small. Using data from Bloomberg, which I'm able to extract, we note that in the same period of October, up to year to date, if we combine Philippines, Malaysia, Indonesia, which is a large country, and also Thailand, we know that the outflows so far have been less than 1 billion US dollars. So if you can put that into context, it's not even 2-3% of the entire outflow back to China. It's only because Malaysia, as in ASEAN is relatively up year to date. I think we are in double-digit gains, whereas countries like Jakarta, their Jakarta Composite Index is up low single digit. For that reason, we are seeing some of the foreign investors taking off money that they have put in. So far, just to give context to the listeners, if we use the first 9 months of the year and we as a benchmark, and we compare to the total outflows that we have seen in October. So in October, if you look at Malaysia, 30% of the total funds that have come in and the net inflows in first 9 months of 2024 have been completely reversed. But if you look at what it is in Indonesia, it's still in single digits, meaning to say Malaysia on a reversal has been slightly stronger. But the big point I want to make about this chart is that if we were just to look at it from a three-year view, and 3 year because institutional shareholders usually hold 2 to 3 years, what we will then understand is that if we were to be worried about more sell downs, then I think we have very little reason to worry about Malaysia. Malaysia is the one in the dotted lines, and this is a cumulative inflow. And now you see the cumulative inflow is high in 2021 because that was when they first came in after ASEAN, after the COVID-19. And the line that is highest over here is actually Indonesia, where the cumulative inflow to date is still 5 times that of Malaysia. And of course, in the near term, the China stimulus news, we probably won't hear the end of it yet. We are expecting October for them to also continue to think about fiscal ideas. And I'm pretty sure Danny would be the expert in this area. But just let me focus on Malaysia. Kenanga has come out with a report to say that we need to be a little bit more careful, especially in terms of adding positions in the near term. When we look at the criteria, we think that if you are having a high year-to-date growth in foreign shareholding, which you can see in the bottom chart, one is the December position and one is the September position of foreign shareholding. We arrange it from left to right, from high change to lowest change. And Bursa stands out as one of the largest changes, and the rest of them about 2 percentage points changes between CIMB, Tenaga, and Gamuda. So perhaps these four names are those that we think have some risk of reversal, particularly since their year-to-date gains. This chart is probably 1 week old. Those are the returns on a year-to-date basis. So these two criteria combined, we think that there could be some risk. Although Gamuda, for example, we believe there is a chance for them to have automatic inclusion into the KLCI top 30, which means that the support level should be quite good, even if there was going to be sell down. We will probably know whether they will make it into the KLCI by November. Okay, having said that, I think as a strategist, I am not asking investors to sell those stocks that I mentioned. I think there are ways to go about it, including hedges. And what I mean by hedges is that one cannot really be so confident to say that that there will no longer be flow impact because the China market is still at least 20-30% below its 5-year peak. And for that reason, any single stimulus that is seen to be very effective may cause an outsized flow back into China in terms of funds. So we think of three areas here that investors can position, which is through commodities, through economic activity, and the wealth effect. Now, this is in order of priority in that we think the first order will be commodities. Press metal is quite significant, and this stock, the downstream products, i.e., the aluminium downstream products, only 12% of it goes directly to China. But obviously, if aluminium prices increase due to Chinese demand improving the whole world over, there would be an improvement of average selling prices. So P-metal is one that we like. However, we think that the one with the larger potential is actually OM Holdings. So OM Holdings is a smaller cap stock. For those who follow OM Holdings, essentially they produce the materials, i.e., ferrosilicon and ferromanganese, which is an ingredient used in making steel. So if China's property and construction sector improves and the demand for steel increases, we also think OMH is the one that gives you better risk reward. Kenanga is one of the houses that cover PPB. So PPB has a investment in Wilmar International in Singapore. And Wilmar International is one of those companies that have 50% of its business in China, including having a very dominant position in edible oils market. So that's one more way to play it. Secondly, on economic activity, PCAM, if you are familiar, part of their uh, output or what they sell is actually the raw materials to make plastic. China happens to be one of the largest consumers of these plastic materials, and given that. PCAM is one of the names that we are currently watching for. Although in the near term, we are asking investors to exercise a little bit of caution because over the next 2 quarters, we expect earnings won't be that great, given there is a new PIC, Petroleum Integrated Complex, coming up, where there will be slightly higher depreciation. So not that we do not like the stock, we think that there's still a little bit of uncertainty near term. In terms of wealth effect, it means that you feel richer. It doesn't mean that you have more money in your pocket already, but the wealth effect, we like SIME and IHH. So SIME, that they had the distribution of the BMW in China, that is going to play well on the wealth effect, having seen them recently close down some branches. For IHH, their hospitals, this one in China and in Hong Kong, it contributes to about 6% of its top line. So these are some of the names we think investors can hedge if you want to make sure that your portfolio can benefit if China's stimulus does achieve its intended economic effect. Now, just very quickly on this chart, I think usually the institutional investors probably have this type of way of thinking and it starts from the question of if Malaysia is a good destination to invest for foreign investors, will they come in and buy bonds or will they come in and buy equities, right? So this is one of the questions to ask. And I think what we have done here is we look at the yield of the bonds, i.e. the coupons that you get on the bonds versus versus the yield on equities. The higher the yield, the more attractive it is. So currently, when we look at the yield of these two products, currently the equities yield is about 6%, and the bond yields, of course, it's about 4%. So when we look at this type of returns or the returns that can be expected by the investors, and we take it against its long-term averages, we can make the case that equities is still the more attractive asset class at this point. So that helps us form a view to be bullish. Now, Kenanga, we are perched at the top quartile among the 18 brokers in the market, in that we believe that this year there is still a chance to end above 1,007, albeit October is a bit of a risk-off, cautious environment, as I have illustrated earlier. We believe at this point in time that the market is worth a 16.5 times PE because we are getting into a high investment cycle. And we last saw this in 2011 to 2014, where we also hit that type of PE. We believe that the ringgit currently hovering close to 430 is where it will end the year at 4.25, but we think that it will be 4.10 at the end of 2025. Now, very quickly, the bottom graph may not be very extremely useful, but I think it does help compartmentalize what we like to what we don't like from a sector perspective. The one that we are slightly contrarian or different from the market is that we think that property is currently a bit more expensive already, so we are underweight. And from left to right, the ones that we like most is banks, utilities, oil and gas, and gloves. I will quickly elaborate on the Malaysian market strategy. I don't wish to spend so much time on a budget wish list because there is nothing really outstanding in my view of our compilation. But essentially, in one sentence, it is just carrying out and fulfilling some of the concepts that the government has already put out, and we believe that to this end, there will be a strong implementation and rollout. Locally, when I see the clients, I think there are three plays that we like. We like to see the broadening out play, negatives priced in, and overhang removal. Broadening out play, in very simple terms, is that we are now seeing far more foreign interest in second liner stocks. So in the first half of this year, that was pretty elusive in that we didn't see any much interest in that space, with all the interest in the bigger names, especially the Maybanks, the CIMBs, the publics. But today, as you can see from the chart below, in certain of those stocks, especially in the green, we are now approaching new highs. And where we think that some area that is still due for re-rating is public and RHB, for example. And we believe that the broadening out play shows that the foreign interest is now willing to go even deeper than what they previously only considered, i.e., the very big caps. Secondly, negatives priced in. I think when we looked at negatives priced in, those who follow the stock market will know oil and gas and tech are two sectors that sold down in August and haven't recovered. We believe that the one that is truly priced in right now, i.e., the fall in share price, is bigger than the fundamentals drop, is oil and gas. In this space, we like a few names. We like Dayang because we believe that at the upstream services space, we cover several names, and all of them in unison find that the daily charter or the renewed rates are still holding the same or better. This means that the demand is much higher, even though the news headlines like to create some concern, especially on capex of Petronas, which we do not see materialize in the actual awards being in good flow. But if you are a little bit more concerned about Malaysia only, then if the oil price and demand is good, we believe Wasco is another name. Wasco does pipe coating, and this is a global player. Now, the chart below is just a valuations chart, and those two lines that have dipped the most means that their valuations have come off the most since the early part of the year, and that, to no one's surprise, is oil and gas and also KL Tech. In the technology space, however, we don't share a very strong conviction right now. Second quarter results that just passed was still quite bad for tech, and moving into third quarter, given that the tech sector is a little bit more sensitive for the US dollar receipts when in their revenue, this is likely to further compress their profits. So for the near term, investors would, over the course of my past 2 weeks, speaking to at least 10 companies, none of them have failed to ask me what is the forex impact for this year, as well as next year if ringgit continues to strengthen. So for now, in tech, we are quite selective. We like certain parts of tech very much. For example, this chart shows that a data center. So in a typical data center, the bottom axis is the time. You will see that from planning all the way to construction is about close to 20 months. But beyond that, there is something called the fit out process. So the fit out process is a probably 9 months process where you actually put in all the servers and switches to make the data center work. So for the first half of the year, any of you who have invested your money in construction and property stocks, well done to you. You're probably sitting sitting on some good gains. We're trying to say that moving on from here, where the market will likely appreciate as the next leg up, is when the data centers themselves get fit out with all these equipment beyond just the core, i.e. the brick and mortar building. So for that, we like NationGate, which is assembling servers, and also PIE. PIE, for those who follow, is in the area of switches, and with new customers leverage to this space. For those who want something with greater visibility, and in that I mean good order book flow for a 2-year view, we think Kellington is one that we like because it is a strong proxy for fab expansion and with a very robust order book. Secondly, after talking about negatives priced in, the last point I have is overhang removal. In overhang removal, currently we like three areas can be described by this. One is renewable energy, telco, and gloves. I think the one that's more interesting is renewable energy and gloves. So let me spend some time there. So under renewable energy, those who follow some of these names would have seen some of the share prices peak already and hasn't fully recovered. We think right now is the good time to start to look at it again because sheer number of contracts coming up is going to double from the previous excitement period. So in the past, this large scale solar, this RE program under LSS4 versus what we have today, we believe that the total opportunity is about double. So for that reason, the pie is going to grow. In the fourth quarter, we will have probably close to 2 billion worth of awards in this program called CGPP. And then further from there, the LSS from first quarter next year will offer up to another close to 5 billion worth of total opportunities. So for that reason, because the pie is growing, we believe in this way you need to own the market leaders. So we like SolarVest better than Maiden. Both obviously are EPCC or contractors in this space, but Maiden has a 30% market share. Sorry, SolarVest has a 30% market share versus Maiden that has 10%. So in a growing pie environment where margins are good, we believe you go with go with SolarVest. On gloves, we upgraded the sector quite recently, and coincidentally, it wasn't an upgrade because of tariffs. For those who have seen the glove sector, it has been an overhang, and Kenanga has been underweight for close to 2 years before our recent upgrade, because I think the Chinese glove makers are now in a way being able to hold a lot of sway and a lot of power in terms of dictating prices. We think that era is going to be over now that the tariffs will be slapped from 2025 onwards. And what it also means is because right now for any exporter from China to go into US will now have higher barriers of entry. This will also cause them to think twice, even if they want to start out a new plant in China. Some of the brokers also like the view of going to Vietnam and Southeast Asia to expand, but we will also need to know that going into these markets no longer give the Chinese glove players the same advantage, because those Chinese glove players in China right now can use coal, whereas if they go to other countries, they will not have that luxury of using the cheaper and possibly dirtier energy source. So for those reasons, we think glove is due a re-rating. We believe currently there is a lot of value in Harta Lega and in Kosan, although in Top Glove, that's our least preferred. The reason is quite simple, because the the Malaysian players, when it comes to how much they actually export to China, to US, Harta Liga is about 50% and Kosan is about 50%, as you can see from the chart on the right. Finally, there is a table that I have here. Just quickly flash it to talk about Ringgit impact to the stocks. However, I will just cap off my presentation today by saying that we are not really advising clients to buy and sell stocks because of the ringgit. and that is one of the areas that is conspicuously missing from my pitch. The reason being, we believe the US elections is simply too hard to call. And if a Trump presidency was to be the case come November, he may exercise all his policies, which may also then be inflationary. And when it is inflationary, it also means that it will be harder for the US to cut rates. And given that, we may even see an opportunity for the dollar to strengthen against the ringgit. So for that reason, we don't have the conviction to ask investors to look into dollar beneficiaries as one of the plays. I think I will just flash these topics for about 2 seconds. And these are the ones that we like. And then in the small cap space, we mentioned SolarVest, K-Rex, Intex, which is the steel product manufacturer, and MKH, the property player, are the names that we like. And I shall stop my sharing here. Back to you, Adrian.
Hey, thanks, Peter. That's been quite very insightful sharing on the flow and how do we navigate when there's a movement between the yield on the bonds and versus how it would, should we still look at our is our Malaysian market still attractive in that
Yeah.
context? And probably now we can proceed to Q&A. We have about like 5 to 10 minutes time. So for those that have actually burning questions, you can actually put it in the chat box like here. Yep, I just said hi there. But let me get the ball rolling in the context like budget is just around the corner, and while you have mentioned that there's not much expectation to start off with, is there any like minimal expectation of at least the execution that we hope to see happening within this upcoming year? Like, is
Yeah,
the subsidy
that's
cuts a
a
delay?
Yeah, that's a good question, Adrian. I try not to be too technical in my answer,
Hmm.
but I would say that we believe at this point in time, at least from my discussions with my econs colleagues here,
Hmm.
we think that whilst it will still be a expansionary budget, the likelihood of the speed in carrying out the subsidy withdrawal will not be as quick as we would
Hmm.
like. And for that reason, Malaysia will still have to spend a bit more. And for those who follow the mathematics about it all, the fiscal deficit figure to GDP, we think it will still be slightly at about 4% or slightly more. I believe the Prime Minister and also the country would wish to see closer to the 3.5% levels.
Hmm.
But we think in the near term that is probably going to be slightly difficult and more challenging. This is not all bad news because if the subsidy rationalization was to be a bit slower than expected, especially RON 95. So watch out for consumer counters and the likes, which probably is going to be a better news for a bit longer. Of course, the market and also Kenanga is hoping and hopeful that if we were wrong, we wouldn't mind it at all because what it would mean is that the country
Is
is committed to meeting all
yep.
its fiscal deficit targets, and those who watch closely the capital markets will know that the upside risk here, or the plus side benefit, is that Malaysia could be seeking for a credit rating upgrade, right? Meaning to say
Yep.
that our international credit rating agencies might be willing to confer to us a better rating, and that's always a good thing from a investable country sort of level. So let's just wait and see. In the near term, we think that the probably in this budget itself, our house view is that we may not likely see any more um, uh, minimum wage changes in the
Mm,
budget itself. That is also our expectation in arriving at the total spending that we expect for the country in 2025. So I'll just stop there unless you have any
okay,
further questions. Yeah.
cool. So before I continue with some of the questions that I have, there are actually quite a number of questions on the floor. So let's start with Akmal. Hi, good evening, Akmal. So Akmal is actually asking that why Tongguan share price has been falling, or is there any possible reason?
Mm. Yeah. Yes. Thank you, Alma, for the question. Okay. Right now, Tongguan is one of the stocks that we like. We believe even in a valuation angle, the realities is that it is one of the cheaper names if you like plastics and packaging exposures, given that it is trading only about 8 to 9 times, which is at a discount to some of its other peers in the likes of SLPs and all that. We think that in terms of very near-term dynamics, currently its exposure in terms of currency is one of the reasons why the stock hasn't done well. If you can imagine, their business is exposed to dollar business, so that once dollar is weakened, or i.e. ringgit strengthening, in the near term, or at least the next quarter, they probably are less likely to surprise positively on earnings. So I think in the near term, we believe that to a large extent, the fall in the share price of over 20% doesn't justify the
Mm,
fundamentals, at least in the near term, of how much the ringgit has strengthened, right? So I think for that reason, we still find value in Tongguan. For those who follow the stock, we also know that Tongguan for those who follow the stock will also know that Tongguan has a stretch film business, whereby the stretch film business, because of the high quality, is often appreciated more by other countries that require the quality for its stretch films. I think another reason I can think about, Akmal, is because within that same space, for example, plastics and packaging, certain names like SLP, another peer, is doing relatively well. And if you were to check its share price, is relatively flat, slightly up. And the reason is because there are alternatives that in the near term, in the very short term,
mm,
benefit from ringgit and an exchange rate, because they sell to 65% of sales, for example, to SLP is to Japan. Now, Japan, as you know, if you monitor their currency improvements, probably contribute to a larger appetite or a purchasing power. So for that reason, I think when translated back to the earnings here, that's probably a pickup. So I think because in the same space there are some winners and losers in the near term, that is why there is a bit of a, in my view, weakness in Tongguan, and also for the fact that Tongguan is relatively illiquid. This will be my third reason. But that doesn't mean that it is not a good accumulating opportunity for investors who look beyond a short-term view. Yeah.
okay, thanks, Peter, for the very detailed insights on Tongguan, which not many people actually really look into Tongguan, even on sell
Mm,
side, if I'm not mistaken.
mm, mm.
So let's jump to the next question because we have a very short window of time, probably another 5 minutes. Uh, let's try about 7 minutes. From SW, how will MACC investigation impact YTL Power shares? A very interesting question, which we have discussed this morning or the morning before on
Yeah.
the analyst briefing recently, right?
Yeah, thank you. Thank you for that. Uh, yes, I think currently, even within the institutional fund managers community, I would say that it is not a concern, but it is something that investment community hopes that it will quickly be resolved, right? So I think that is still currently an overhang. And the reason why it is an overhang is because while in the court of public opinion, the fund managers hope that the YTL's name, for those who follow the news, MACC was trying to find out more information about one Bestari net, and that project YTL had previously won through tender, right? So I think what is happening right now is the market is hoping that there will be news or statements to, in a way, uh, absolve YTL of any wrongdoing, or say that there are no investigations charged. The simple reason is because YTL, in that the current deal, that one Bestari net itself, the news tell us that the figure is not very big. It's 2.7 billion, right? But why the share price has come down so much is because investors are concerned. What if there is going to be another Malaysian-based tender coming ahead, and because there's an overhang on this deal, will it then jeopardize or hurt its chances for future
Mm,
Malaysian
yeah.
bids lah? So right now, YTL Power's business is about 90 to 95% overseas, but we also don't want that overhang to weaken its chances of any future Malaysia bids. So I suspect that is why the share price hasn't performed yet. And of course, at this point, at Kenanga, we recognize the value. It is there in terms of upside potential, but as a strategist and also our analyst here, we are not yet banging the table.
Okay. Let's move on to the next question from Mr. Lollipop. That's an interesting name. Are there any potential beneficial counters for JB, Singapore RTS, and economic zone play?
Yeah. I think at this point in time, what we think that those names that are leveraged to Johor definitely is just something that will continue to be in our radar. UEM Sunrise, that we don't cover, looks interesting to our team. We also think that Sunway has been one of the names that would benefit by virtue of being closer to the second link, and Forest City development over there probably could have some spillover as well. But Sunway, we will probably watch for entry point because we think that currently the market at over 4 ringgit is probably a bit frothy. So we will look for a better entry point for Sunway, if we were to be honest. Other than that, in terms of Johor side of the play, we think currently the data center theme is still something that we like. And because that is something that we like, we continue to watch out for some of the land sales opportunity, even the likes of KLK that have good Johor Land Bank, for example, is something that is worth looking into the radar for potential land sales. Of course, on the construction of data center side and who is going to benefit from that, we think that we will play it through Gamuda. That's still our preferred play when it comes to data centers, not specifically Johor, of course, but on the data center team. In terms
Okay.
of, mm, mm,
I
yeah, sorry,
think
please go on, Adrian.
that's really good on the data center and Gamuda. Yep. But we are running a bit short of time. Probably can we take two more questions and we can head to it, Danny. So the next question is within our forecast of the reaching above 1,007, right? What will be the main driver of this company? I mean, which company is driving this
Yeah.
valuation?
Yeah, thank you for the question. I think when we look at the entire composition of 1007, obviously these are only the sectors that are represented in KLCI, lah, right? So we believe they currently, after October and November, when the elections are done in the US And when there's a little bit more risk on and the fund managers here start to put more of
Mm,
their money into work, they will look for laggards potential. So planters is one of the laggards areas so far this year. We think that they will still have to selectively buy some of the banks because in Malaysia, we know that Bank Negara is likely to keep rates relatively stable when the world around us is starting to cut rates. So for that reason, we think there will still be a good place and reason to hide in banks. So banks, we are watching for that. Planters, we are watching for that
mm,
because right now, plantation, if those who monitor the CPO prices will know that CPO prices have already breached 4,000 as well in the futures market. And then thirdly, we think that one of the areas that could be a resolution is in the telco space. Now, telco is no slouch when it comes to representation in KLCI, but
yep.
for the past 2 years, its valuation has dropped 20 to 30% since the introduction of the 5G network, which it seemed to be an overhang when there's uncertainty. So we believe that either by fourth quarter or by first quarter next year, there will be certainty already in this space. And once that is peeled off, that's when the counters will start to re-rate up again. So these three sectors probably will help the KLCI make a final push to that area, and we also expect Gamuda to be included into the CI by the end of the year. The dark horse here is perhaps 99 Speedmart. I think based on estimates around they are still about few percentage points away to getting into the what we call the automatic inclusion area. If your market cap is at least the 25th biggest and you satisfy some other criteria, you would be able to get automatically included. So that's one that we don't cover, but we are monitoring as well.
Okay, that's really insightful on the weightage of what the sectors potentially
Mm,
gonna move us up. And yeah, telco and plantation is actually really interesting.
mm.
Okay, let's jump to the last question probably. Sorry, Paulina, that we couldn't take your inheritance tax question, but this Eunice. Eunice is like, what is the potential impact of Malaysia joining BRICS?
Yeah. I think right now the Southeast Asia sort of tension is quite high, right? Even in this region, it does look right now that the statements that have come up from Prime Minister Anwar, in my humble opinion, looks to have start. To move away from something more neutral to somewhere closer to China, in my observation. Although I think in the totality of things, Malaysia is still seeking to be centrist, right? In terms of being a small country in the bigger scheme of things, with the two big superpowers. So in my mind, I think yes, we are slightly now more towards leaning towards China side of things, but I do not expect that this will have very significant ramifications, simply because I think in terms of the bigger picture compared to our neighbors, for example, the likes of Singapore, the likes of Vietnam, there is even clearer leanings towards a certain faction and certain side, right, Adrian, in terms of
Yep,
relative terms. So I
yep.
think I think that it is if you want to look at it from a context of a spectrum, we are still quite centrist in in that sense. So I am not very worried. I am also thinking that some of these stances could be also part of looking out for our own interests,
Mm.
ours meaning Malaysia's interests, and to that extent, that formation of closer to BRICS is probably from an economic standpoint rather than signaling a political leaning. If that helps to answer the question, yeah.
Okay, probably the, hold on. Okay, I think we are good on time. And We'd like to thank Peter for his time for tonight and also his patience in explaining every question in great detail, which actually provide our viewers that immense information, especially for stocks like Tongguan and how YTR Power Bravery highlighted in terms of their revenue is almost 90% from overseas already, and how was the sentiment. And I think thank you, Peter, for that. And it
Yep.
was really a very good session. Uh, but for now, uh, can we invite Mr. Danny to the floor? And thank you for the night, Peter.
Hi, Adrian. Thanks for having me. Let me share the slides first. Okay. For the next 20 to 25 minutes, since there has been lately a lot of interest in the Hong Kong stock market, I think this topic hopefully would help all the viewers online. And this is, of course, about the Hang Seng Index.
Thank you, Danny, for spending your time and evening with us from Hong Kong. And we shall invite Isabelle to the session. Hi, Isabelle.
Hey, Adrian. Danny, thank you so much for your time. We really appreciate it because we saw that Hang Seng Index was rallying and we wanted to give our investors and traders first-hand insights from you guys. So thank you so much to you, Danny, Mr. Danny Chu, and to the wonderful team at Hang Seng Index. You guys know who you are. Thank you so much. And I know Zara is supporting you today. Thank you, guys. And Peter, your first debut session today was really exciting. Especially like that, you have a really poised way of sharing your content, and I'm sure our viewers appreciate that very much too. So for me, it's just a quick 10-minute session where I'm going to cover a bit more on where you can get into how you can access the Hang Seng Index via warrants in Malaysia. I'll share my slides really quick. Okay, excellent. Mm-mm-mm-mm. Great. So, quick disclaimer, as you all know, you can screenshot it whenever you want. Speaker, that is me today. Awards that we've won as a warrant issuer in Malaysia. The ones that we've won in red are the ones that especially come out towards warrants. That goes from 2022, 23, 24. We have won Best Educational Initiative, Most Innovative Use of Tech, Best Warrants Issuer. And yes, topic for today. So, a tiny bit about today's big idea is this is just my personal opinion, honestly. If you resonate with this idea, because I'm more of a technical trader. So, for those of you who like the fundamentals, you got the fundamentals. For you, those of you who like the technicals, here we go. So, the first thing, if I was a technical trader looking to trade the Hang Seng Index, I would be looking at patterns, right? So I'm looking at the patterns from this was back in 2020. And every time I wrote the black line, it is 1 year. So 2020, 2021, 22, 23, 24, coming up to end of the year, 2025. So just based on the last 5 years, what does the Hang Seng Index tell me technically? I can see that number one, this is using the 1 week candlesticks for those of you who like to follow technical analysis. I can see that number one, it likes to follow the Fibonacci supports and resistances. Number two, it likes to follow the EMA 50 and 20. You can plot that. I always put my EMA 50, the longer ones, in green, and the shorter term ones, I put it in red. And finally, this is a really strange thing that I've noticed over the past few weeks. There has to be a bullish or bearish engulfing at the Fibo levels. So this is just a 1 week chart. Of course, you can drill down to a 1 day chart, but I just want to see what works first, right? So I noticed over here, when it hits the fibo over here, there is a bullish engulfing and there is a reversal pattern. Over here at the top, there was a bearish engulfing followed by a head and shoulders, 1 to 1. Over here, there's a bullish engulfing just there. A fibo again. You see the green line. There was a bullish engulfing. Fibo again. Bullish engulfing. The fibo lines are at the 15, 18, 21 and a half, 26. Fibo bearish engulfing. Right there, same thing. So you notice whenever it hits one of these lines, it's an opportunity for us traders who want to trade the markets to really sit up and take a pay attention. You know, it's like somebody just called your name, you can snooze all you want, but suddenly you're on best behavior. And finally, a bearish engulfing, and you can see, you can always screenshot my charts and have a look at it in closer detail at your own time. But of course, this is just an opinion. So what do you do with that? Oh, quick one. For those of you catching the structured warrant session, which we're covering in 10 minutes for the first time, please press 1. If you're catching it for the second time, please press 2. If it's the first time you're ever seeing my face, please press 0. So I know you've never attended this session before. So I know how fast and how slow to go. So second thing that I would do if I was trading the market, I would zoom out to 1 day charts. This 2023, 2024, 2025 January. And earlier I said, right, the bearish engulfing happens here at the fibo. Again here. Actually, this is a long-term support line. There was a bearish engulfing here. And of course, there was a bearish engulfing just that week. So I was zooming closer. How do I know what's going to happen next? If I was a trader, I want to be able to ride the trend, right? I don't want to just jump in and out and just let luck play with my profitability. So the idea is, for example, this is just an example, prepare some game rules. So if you're a trader, if it crosses 24K, that means around here, 24,000, you can consider a call warrant until 26. If it crosses below 20K, you can consider a put warrant until 18. You know, have a plan, have a strategy on how you want to trade warrants. All right, so that was the big idea for today. We have got 2 updates for you for structured warrant traders. Number 1, Bursa has introduced a new naming convention temporarily for structured warrants. I say temporarily because eventually we're going to run out of alphabets. So CWAA, CWAB, CWAC, and so forth. These are still call warrants. It is not a brand new product introduced to the market. PWBA, PWBB, BC, these are put warrants. Same thing as well. You notice that the names now have 4 alphabets, not just 3 as before. The next update I have for you is that we've issued a new batch of structured warrants. Ours, the code that came out the other day, it came out on the 16th of October. That's today. So 16th of October, we had CWAJKLMNO. So we've got 6 call warrants out. We've got 6 put warrants, BL, BM, BN, BO, BP, BQ. And then we've got 99 speed marts over here, Malaysian, Inari, UWC. So yes, we did run out of inventory for the last week. Thank you for your support and your love. Thank you for making us the #1 warrants issuer in Malaysia by volume and value. But right now we've reloaded our Hang Seng Index warrants thanks to your strong demand. So which of these 6 should I choose? A quick example, a quick and dirty way to analyze the warrants. Let me just show you here. If I can move my bar. How do I choose which one of the 6, right? If I was a warrants trader and I wanted to take advantage of this new issuance, I would quickly look at CWAM and CWAO. I know that most of you prefer to trade warrants with a lower price point. So for example, all my other warrants that I've issued, I've screenshot over here. You can see the price point is quite pricey. CWAJ is at 113, AK is 94 cents, AL is 77, AM is 51.5, and then my put war, and then my other two, there we go. AM is 51.5. These two I'm choosing simply because I know you guys prefer the lower price points. But I'll show you that we've priced it to make it sensitive so you benefit as well. For BL and BM, oof, 295, 257. And for the other four more remaining put warrants, I've got 221 ringgit, 156. I know they're expensive for warrants at the moment. So back to what I was saying, these are our brand new warrants, but let me just go back to the two that I mentioned, the two that I want to spotlight for the core warrants. The quick and dirty way to analyze core warrants is, yes, number one, I know you guys like to look at absolute price, but I'll show you that it is sensitive and it can give you ROI as well with the way that we price it. So for example, if it's 55 cents, that means Hang Seng, for example, moves from 2030. I'm going to give you the example of a round number actually. 28, 2280, for example, all the way to 2500. I can see that 55 minus 51 divided by 51, that is an ROI of 7.8%. And that's if the Hang Seng moves approximately 200 points upwards, right? And I can see over here, 37 cents if Hang Seng is at 2508 to about 2272. That's approximately about 300 points as well. Wait, let me just double check my mathematics, which is very good at 9:30 p.m. at night. Yeah, that is about 300 points. What is my math really, honestly? What is going on, Isabelle? 200 points. So that's about 37 to 33. So 37 minus 33 divided by 33, you can see the ROI is 12% or so. Same thing as well. I just wanted to show you an example that these are a bit more pricey, but you can consider them. CWAM and AO, the ones I mentioned earlier, it's just a repeat slide. And finally, just to wrap up, because I know we have a long session today, my final slide is this one. For Telegram, always remember that you can message us here, like our Warrants Telegram. We'll also have our private one-on-one chats. One-on-one chat. So if you don't want people to see your messages, you can always ping us over here. We have our YouTubes at Kenanga Group, the award-winning videos that we've done, and our upcoming webinars. If you are not in KL, there'll be Kenanga Market Outlook. That is today. We started doing Raku Insights. They're on Tuesdays. They happen every 2 weeks. Then I'll give you updates on warrants. And finally, we had InvestSmarts at Mid Valley events. We were there last week. Upcoming, we've got the Bursa Marketplace in Kuching, Viva City. If you happen to be there, please swing by 9th November. And we've got Sabah Warrants Day at ICC Kota Kinabalu if you happen to be there as well. So thank you for your time, and that wraps it up for me for warrants.
Hello, hello.
Hello,
Thanks,
hello.
Isabel, for sharing us this session also. And I believe Singguan have a question on. Let us check. What do you mean by low inventory?
Low inventory because for warrants, they are issued by warrants issuers such as ourselves. So let's say I'm issuing 50 million units of a structured warrant. And when I run out of inventory or I approach something like 45 million units sold, I don't want the price to fly out of my control. So what I do is, the normal bid and ask. Am I mirrored? Okay, imagine with a pencil is the bid, okay? So let's say the bid and ask. I will actually maintain the bid price. Let's say the bid is 10 cents. and the offer is supposed to be 10.5, correct? I will increase the offer and I'll put it maybe at 14 cents, 15 cents, and the matrix on nagawarrants.com turns orange or red. That means do not buy. The reason is because I want to control the price so I can have a fair price. What happens if you can say to yourself, Isabelle, why don't you just let it run? Let market forces be and let the warrant fly to 20 cents. What happens then? So I'll explain the logic for you, Sengguan. The fair price was 10 cents, right? And let's say I increase the offer to 20 cents. Normally, a normal retail trader will queue. So they will queue from 10, 10.5, 11, all the way to 19 cents, 19.5. The problem is, another retail trader could be buying the warrant at 20 cents. Let's say he bought 10 million units. If he bought 10 million units and he tries to exit to 19.5, and all the retailers queuing there is only 1,000, 2,000, he will never be able to exit. And he will end up crashing the price all the way to 10 cents because the issuer is only queuing the 5 million at the 10 cents. So that doesn't make much sense for our issuer because we want to be a responsible issuer. So that's why when it reaches low inventory, of course I can let it fly. It's not, I can technically say it's not my problem, right? But as a responsible issuer, this is the responsible thing to do to not let it get so out of control and crazy.
So it is also a way that, if I were to put it in plainly, is like we are also trying to take care of our buyers and sellers in a certain way.
Oh, 100%. Yes.
Yeah, okay,
Yeah.
that's cool. And is that's I think that the best part is with the private chat we can even reach out to Naga Warrants to see if there's a how do I put this? Reach out to Naga Warrant to see if there's any promos or buy bids that can if the sizing is quite interestingly huge.
Yeah, we offer buy bids, so you can see our Naga Warrants Telegram. We'll send the link over, but it's really easy to remember. Just go on Telegram, search for Naga Warrants by Kananga. It's an official channel, and you can see the daily buy bids. So instead of buying in an offer price like everybody else, you want to get stuff at special price, you can always look over there, and we'll offer it on bid price. All you need to do is queue up, and then we will hit the bid price if it's at the lowest rung of the matrix.
That's very cool because I don't notice any warrants issuer out there that has yet a private chat that people are able to connect. But nonetheless, there's another question from the floor from Z, if for those sold out inventory, your buy bid price will not maintain as it is, that you will be revised a bit down as in sold out. If I were to be buying at the moment, the next moment I'd be losing a bit for nothing. How do I avoid that?
If it's sold out, sorry, can you repeat the question a bit slower? I can't seem to read it on my chat. Because for a sold out warrant, we don't decrease the bid, we maintain the bid.
Yeah.
So if it's 10 cents at the bid price, it'll be fair at 10 cents. It won't suddenly reduce to, one side will reduce to 8 cents, and then the other side is maintained at 10.5 on the offer. Yeah. So
Mm.
let me just double check the question.
Yeah.
So I'm just trying to understand it. Your
The
bid
buy.
price will not maintain. Okay. So bid price, yeah, the bid price follows the market, right? If, say, you are buying Gamuda and Gamuda's underlying goes down 2 cents, if the warrants has a 2 tick sensitivity, it will go down as well by 2 ticks. So you will rise the bid down once inventory is sold out. But yeah, so maybe Z, to understand your question better, because I know sometimes it is a bit of a time constraint, and I really want to get to the crux of the problem, and I don't want to answer your answer so simply. Messages on Telegram, our private chat. Let me sleep tonight. Tomorrow morning we'll get back to you, and then we'll discuss it until you 100% understand and we're both on the same page. That's how we work. All right.
Yep, that's really cool. So far I think there's no question. So let me do a bit of a
Thanks, Z.
advert in the context where, if you scroll into our chat for existing Kananga warrant traders, this is your moment to shine. show us your best trade of Hang Seng warrant and a screenshot of that, and you will stand a chance to win $100 Shopee voucher. And these trades must be in between the 1st of September until the end of October. So if you already have something really great, do send it in. All right?
Rocking.
Is there any limitation to that Shopee voucher?
The limitation, if you are one trader, you get one 100 ringgit Shopee voucher. Don't send me 20 of your best trades and expect 20 Shopee vouchers, all right? Easy. We're just trying to encourage you guys and show us your winning trades. The mechanics of it will be in the chat. Thank you so much.
Okay, so I guess let's wrap it for the night. And thank you, Isabelle. Thank you, Danny, and thank you, Peter, for um, getting this session up where we actually put everything together. It has been very insightful, and yeah, we have been holding Peter back in the office for a bit,
Peter,
and
are you still in the office?
yeah,
Oh, it's okay. It was raining just now.
yeah.
He's there from like 7:30 in the morning until like 9:30. Okay, we have an
Yeah.
award, so you're getting the longest in the office award. Crazy.
Yep. So tomorrow's breakfast gonna be on me, and I wish to get Danny breakfast also, but yeah, a bit far, so I'll find time to visit Hong Kong. But yes, thank you everyone for joining us tonight, and we appreciate that. And do follow us very closely on all our Telegram channels and also YouTube, and yeah, so that you are not losing out in the market. All right. See you guys. Love you guys. Bye.